COVID-19 pandemic changed the world dramatically. China, that was once seen as the manufacturing capital of the world, is now seeing its position dwindling. China faced massive supply chain disruptions, and the world is now looking for a more reliable partner. There is shift in power dynamics, giving an opportunity to economies like India and Vietnam in the manufacturing space. One sector that is witnessing shift from China and continued strong global demand globally is the chemicals and the specialty chemicals sector. Today, we will discuss one such listed company that has grown from being a single unit tire cord manufacturer into a leading diversified chemical conglomerate. It is none other than SRF. SRF's portfolio covers fluorochemicals, specialty chemicals, packaging films, technical textiles, and coated and laminated fabrics. It has 14 manufacturing plants with exports in over 90 countries and a turnover of Rs 14,500 crores in FY 21-22. So what makes SRF hot? First, SRF is a leading player in India and among top players globally in the segments it is present in, including chemicals, packaging films, and technical textiles. Second, its leadership position in high margin and fast growing specialty chemicals business. Third, SRF is increasing its global presence in fluorochemicals by entering new markets. Fourth, it is the second biggest player in packaging segment and now diversifying into aluminum foils. Fifth, its superior capital allocation capabilities that has led to increasing contribution from high margin chemical business and reducing dependence from legacy business of technical textiles and packaging. Finally, its robust financials with 3-year sales CAGR at around 21%. The trend is further seen improving with higher contribution from the chemical business. Let's take a look at the portfolio of SRF. Its top business segments include chemical business, which contributes to around 47% of sales. Fluorochemicals and specialty chemicals are a part of the chemical business. The second one is packaging films. Nearly 37% of sales comes from its packaging film business. BOPET and BOPP are a part of packaging films. The last segment is technical textiles and others. Nearly 16% of revenue comes from this segment. The fluorochemicals business. SRF is a global scale fully integrated HFC player. HFC chemicals are primarily used for air conditioners and refrigeration. SRF is among the top 5 global manufacturers for key fluorochemical products. It is the only Indian manufacturer of ozone-friendly refrigerants such as F134A and F32. SRF also manufactures industrial chemicals and propellants. It is the only company in India to manufacture 134AP propellant. In terms of outlook, there is healthy demand for refrigerants from key markets like India, US, and the Middle East. The global fluorochemicals market is expected to grow at a CAGR of over 5% during 2022 to 2027. Specialty chemical business, the growth driver for the next decade. SRF has over 30 years of experience in halogen chemistry. It has leadership in intermediates for pharma and agrochemical industries. It is fully backward integrated player doing contract research and synthesis for intermediates. It has applied for over 378 patents and has been granted 127 patents in exotic and extreme chemistries. It is the fastest growing segment for the company with strong margin, and of course the China Plus One strategy augurs well for the company. It has earmarked Rs 1,000 crore capex in the chemical space. In terms of outlook, Indian specialty chemical market is expected to grow at 12% annually, and the global market is expected to grow at a rate of over 5% in the medium term to long term. Packaging film segment. SRF has multi-country presence with BOPP and BOPET films. These are packaging films that have applications across industries including FMCG, food and agro, confectionaries, soaps and detergents, solar panels, labeling, overwraps, etc. SRF is the largest exporter of BOPET films. It has 2 plants in India and 3 plants overseas. The company has diversified into aluminum foil as well. In terms of outlook, the new BOPET films lines announced globally could result in oversupplied market and put pressure on the profitability. The other challenges for the segment include global demand slowdown, rising energy costs in Europe, and fall in commodity prices. The global BOPP and global BOPET is expected to grow at a healthy rate of 5.6% until 2030. The technical textile segment. Product basket for the technical textile contains tie cord fabrics, belting fabrics, and industrial yarns. It has varied applications such as tires, seat belts, conveyor belts, etc. SRF has 40% share in India's nylon tire cord market, and it is the second largest player globally. It is the third largest manufacturer of conveyor belting fabrics globally, which is seeing a very strong demand. The global technical textile market is expected to grow at a CAGR of 4.6% over the next 10 years. However, the margins are expected to be under pressure. Let's take a look at the financials of the company. SRF's 3-year sales CAGR stood at 21% and profit CAGR at 43%, with its FY22 sales at Rs 14,518 crores and operating profit at Rs 3,593 crores. The top growth driver of the company remains the chemical business. On the margin front, there has been consistent improvement in the margin profile, with its operating margin stabilizing at 25% in the first half of FY23. In the first half, SRF's consolidated business has seen revenues up by 37% YOY and EBITDA was up by 39%. The biggest segment, the chemical business, saw revenues up by 59% and EBITDA was up by more than 2x. The packaging segment has seen revenues up by 34%. However, the EBITDA was down by 5%. The technical textile business saw revenues flat on YOY basis, and there was a significant EBIT decline in the first half of FY23. On the return ratios front, the company has seen consistent improvement in the return ratios because of the improving margins. The return on equity in FY22 stood at 22%, which was up from 8% in FY14. Its debtor turnover days are stable at 53 and inventory turnover days are stable at 6 days. On the cash flow front, the company has seen strong operating cash flow generation. However, the capex has been high. It was at around 19 billion in FY22 and the guidance is of around 22 billion in FY23. On the balance sheet side, the company's balance sheet has become more stronger with its debt equity ratio at 0.42:1. On the valuation front, at Rs 2300, the stock trades at a PE of 31 times, which is below its 3-year median PE of 33 times, but above the 5-year median PE of 25 times. On the shareholding, the DII holding has gone up by 4% to 14% in the September quarter. On the other hand, the public holding has gone down by 4%. Let's take a look at the SWOT analysis of the company. Among the strengths of SRF are: first, its R&D driven diversified multi-country portfolio; second, leadership position across segments including fast growing specialty chemicals and refrigerants; third, its robust financial performance with better than industry growth rate; fourth, its superior capital allocation. Among the weaknesses of the company are: first, margin pressure in legacy business; second, nearly 50% of the revenue comes from the legacy business of packaging films and technical textiles; third, lower offtake in nylon tire cord segment; fourth, capex intensive. Among the opportunities of the company are: first, agrochemicals are witnessing healthy growth globally; second, India's growth bolstered by China Plus One procurement strategy; third, the capex commitment in the chemical business; fourth, traction in international revenues led by refrigerants; fifth, investment in aluminum foil creating business adjacencies. Among the threats of the company are: first, global slowdown; second, high energy costs in Europe; third, global logistics outlook being challenging; fourth, challenging raw material scenario.